Props to everyone for joining us to take a little bit of time, do some extra planning, make sure we're organized and we know what to expect. We're going to jump right into it here. So, in true accountant fashion, we got to have an agenda, just kind of so everybody knows what to expect. Out of respect of everyone's time, we try to make sure you get as much value out of this thing because we do appreciate you taking time out of your day running your business, doing whatever else it is you could be doing during the day to come here and spend it with us. So, we always start with a little intro. If you're watching this, you probably already know who I am. But just to make sure, I always like to make sure that we're not perfect strangers up here talking to you guys. So just quick intro, a little bit about our hosts. And we do a little bit of housekeeping just so everyone understands kind of the format of the event and sort of what to expect over the next hour here. From there, we'll get into our main section. So we're going to spend some time today talking about getting tax ready. Like we were saying, it's already 30 days into the new year. January's already done. We're prime time here going into tax season. So we're just going to talk about some of those documents, some of those expectations you need to be ready for tax time. Then we're going to get into lending strategy. So this is a little bit different, but very interesting because this is the reason I invited Dustin to come talk to us today is we see it quite often where clients, for whatever reason, especially when they're business owners, they don't quite understand how important their tax return is to their lending strategy. And that could be like trying to get approved for loans at banks or for the SBA, especially what Dustin's going to spend some time today and talk about is buying a house. So if you own a business and you're looking at getting approved for a mortgage, Dustin's going to go through some different strategies there on the lending side. Then Lonnie's going to break it down for us and talk about a little bit of business sales strategy as well. So that's our main section. From there, we go into our wrap up. Always do a little bit of recap. We always spend or plan for plenty of time at the end for Q&A. So we want you to ask your questions. I say that it's probably now is a good time to mention too. If you're joining us here, you probably notice this isn't like the normal, typical version of Zoom where everybody's face is up and you can come off mute and raise your hand and ask your questions. In respect of everyone's time, we want to make sure that you're getting the content delivered to you in a easy format, but then we do want to interact with you and we do want to hear your questions as well. So if you go down to the bottom, you probably have to go to the little more button, which is the little three dots to the right, and you go to Q&A. That's where you type in your questions right there. If you go to the normal chat box, it'll probably tell you that the chat's disabled. It's not that we don't want to talk to you. It's that just, like I said, in respect of everyone's time. I don't know if you've ever been on a Zoom call with 20, 25 people and a few different people start talking, things could quickly go off the rails and we don't want that. So just so I know, quick kind of technology check. Everybody knows where it is. Go down there in that Q&A box, type in your first name, type in where you're calling us or where you're joining us from today, just so we can know that works. Last thing I want to get 30, 40 minutes into this and people say, hey, we couldn't use that thing in the first place. So go down there in that Q&A box. Just let me know that it works. Got Christopher from Cincinnati, Sharon in AZ. Very nice. That's where you are, right, Dustin?
I am.
Look at that. We got Ryan from Los Angeles, Paul. All right, cool. We got people from everybody. Illinois, all over the place. So, all right, that's definitely working. Thanks to everybody. All right, from there, we're going to keep going. So quick introduction. Like I said, if you're on here, you probably already know who I am. But if not, just double check. I'm Jake Alexander from Action Accounting. Our business is Action Accounting. We've been around since 2016. We have a team of 11 of us now. We've got 4 main departments in our business. We have a bookkeeping department where we help business owners create financial statements so they can understand how much money is coming into their business, how much is coming out. It's really at the end of the day, we teach those business owners how to utilize those financial statements to really understand what's going on in their business so they can make preparation and they can make plans to grow and scale that business, get approved to buy whatever they want from it, and then eventually maybe sell it with somebody like Lonnie too. So we do bookkeeping, we do tax preparation, which the folks in that department are very busy right around this time of year. That's where we prepare and file tax returns for business owners and then the respective owners of the businesses themselves. Then we have a tax planning department, which is kind of the opposite of the tax prep department, where the art of tax preparation is somewhat of a reactive process. We're preparing and filing returns for things that happened in the previous year. The tax planning department is the opposite. So folks in that department right now, in the beginning of 2026, are already putting plans in place for business owners to deploy strategies and legally and morally pay the least amount of taxes as possible for 2026. And then we have our business consulting department, where if you do have a business that you're looking to grow and scale or put more systems and processes in place to turn it into an actual business instead of just a job that kind of runs you ragged and doesn't exactly do what you designed it for in the first place, we can help you out with that too. So that's a little bit about me. Then we're going to introduce Dustin. Dustin, once again, from Arizona. And you said it's record high heat out there, which is kind of funny because we have record low temperatures over here. How you doing today?
I'm doing awesome. Like I said, it's 81 degrees. Things are great.
There you go. That's great. Well, Dustin Graham, he's the founder of Business Owners Mortgage. He's got over 20 years experience. He specifically helps business owners and self-employed professionals secure home financing with programs that traditional lenders usually aren't privy to. And so he's got this consultative approach. He's not transactional at all. He's always focused on your goals and how your business works and how it earns money. So then he uses those financial strategies built around real cash flow to help people qualify for up to 5 times higher loan amounts than working with traditional lenders. And so if it's investing in your own personal property or even rental real estate, he can help you with that. And so, Dustin, we're going to hear from him here just in a second. I want to introduce Lonnie, and then we're going to turn it back over to you, Dustin. So then we also have Lonnie Veasley, who's a local Tampa native here. So he's a business transfer specialist. He's been helping business owners sell their companies for over a decade, I think 13, 14 years, something like this. I actually didn't know this. I've known you for years, Lonnie, but before doing this, you actually built and sold your own company for like $20 million plus, a petroleum company. And you sold it to a strategic competitor, which I think is pretty genius, is really cool there. So you got firsthand insight into the complexities and emotions selling a business. Lonnie's known for his exceptional client services and hands-on management of every transaction and every detail. He's worked in a wide range of industries. He consistently earned recognition in the Business Brokers of Florida $1 million plus club year after year. So that's who we've got with us today. Myself, Dustin, and Lonnie. Dustin, we're going to turn it over to you, and you're going to tell us a little bit about the world of the mortgage industry here. So you go
Perfect.
ahead, take over as soon as you're ready there.
Perfect. Thanks, Jake. I really appreciate you and appreciate everybody being here. Um, yeah, thanks for the introduction. My name is Dustin Graham. Thinking back 20 years, holy cow, when I graduated college, it was 2006. I moved to Arizona, and that happened to be the peak of the housing bubble. And what we're going to talk about today is kind of a direct result of that housing bubble. I don't know if many are keenly aware of the options that exist for business owners to do both things, like what Jake talks about, how far ethically and morally you can write off your income on your taxes, but still qualify for a mortgage. So we're mortgage specialists for business owners and self-employed. That's all we work with. I've got 20 years in finance, and our team, which is very important in a mortgage setting, has got over 60 years combined of processing and underwriting experience. What I first want to do today is talk about the problem that you face, okay, and the challenges the environment or the mortgage system gives you when you go try to buy your own primary residence, if you're upgrading a second home or even an investment property. Because the number one challenge is going to be provable income consistency. Doesn't matter how you're paid. To get a mortgage, you have to meet the criteria for what the government calls the ability to repay. And that leads us to the new mortgage types that came out of the Great Recession and the housing bubble. And those are going to be, by law, qualified and non-qualified mortgages. Now, the qualified mortgages are what you hear anybody talk about. Okay. These are government-based rules and funding, and they make up about 90% of the market of all mortgages originated in the country. And then you've got non-qualified, which is the exact opposite. You're going to find these have more market-based rules, a capitalistic approach to issuing mortgages. On the government side or the qualified side, these loans are going to be bought by the people that you know, but they're really built for a fit-in-the-box type of system. Okay, your W-2 employees, your salaried employees, people with pay stubs. These are all very easy to quantify what their income is going to be. Okay, if you're dependent upon somebody else to pay your paycheck, you can get a pretty easy qualified mortgage to go buy your home. But if you are the employer or if you are self-employed, it's a bit more challenging because essentially the government is saying we'll buy the loan. But for that, we want to see what you're paying into the system also. So if you're self-employed, if you own a business, tax returns are going to be absolutely mandatory for these types of mortgages. Like I said, this is 90% of the market. So here's what you need to provide to get one of these loans. It's a lot of information. And understand when you provide this information to get a loan, it's not a $50,000 loan. It's going to be a three, four, $500,000, if not larger loan. They're going to be highly scrutinized. Okay. It will feel like an audit when you have an underwriter go through all of your business tax returns and begin asking about deductions or depreciation or where are the missing K1s. So this is what makes this really um, prohibitive of self-employed buyers or self-employed borrowers that want to go buy a home. There's a gigantic gap in the conventional mortgage system that non-QM loans are going to solve. We'll talk about that. So it's a dilemma for you. You're going to call up Jake and say, hey, listen, I need to go upgrade a home. I've got 2,000 square feet and I need 3,000 square feet. What do I need to do on that tax planning section so I can buy a home? And how much more am I going to owe in taxes in order to qualify for that mortgage? So it puts you in a dilemma. Um, we all know that the tax code was written for the benefit of business owners and job creators, but the goal of the American dream is kind of put behind a different paywall, where if you want that government type money, you got to pay the government in. And that kind of puts us at odds with what we want to do as a business owner. It's definitely not your income. I work with business owners all the time. The income is fine. It's just the paperwork that leads you to tough times getting a mortgage. Leaves us a lot of underserved and underqualified buyers and borrowers, but you are certainly worthy. And the solution is the non-QM mortgage. Okay. This is a program designed by the market, okay, the market to fill a need. So we call these things non-QM. So I asked ChatGPT, how and when did non-QMs get their start? And it came out of the regulatory environment after the Great Recession. Okay. The government defined a qualified mortgage. It needs to fit what they say. The non-QM doesn't. Okay. So this is going to be private money where this comes in from insurance companies, pension funds. This is not a small business. I think in 2024, there was $21 billion of mortgage-backed securities securitized and bought by the market. So this is good, safe money. We know that you are qualified. You're not a high risk borrower. This is the good quality money for you to buy your real estate. Now, how do we prove income for non-QM? Okay, you got several different options. We call these light docs. Any one of these will suffice. Okay, so your bank statements give me 12 or 24 months. If you're self-employed and get paid on a 1099, we can use that too. Okay, a profit and loss for certain types of businesses, or if you're asset based. Okay, you got a whole bunch of money in the bank, you got cash to cover the purchase, we can do that too. And then if you're an investor, there's a DSCR loan, which is a whole nother 30-minute conversation on how that goes. Then all we need is that proof that you are the absolute business owner. So you might be asking yourself, what about tax returns? Do I need to show them? Do we need them at all? The answer is no, we don't need them. Can you get a loan if you have tax debt? Yes. If you haven't filed taxes in a while, that's fine. I recently closed a $3 million cash out last year for a gentleman who hadn't filed taxes since 2017, and he's in big trouble, but it didn't matter to us.
On the
As long as you have
tax
a
side,
tax lien,
on the tax
say that.
side, on the tax side is a different story, but you were able to get them qualified for one of these loans you're saying, huh?
100%. We really don't care about your relationship with the IRS. As long as you don't have a personal lien, we are fine because these loans are based upon the ability to repay that the business generates and also collateralized by the asset themselves. And yes, these are just normal loans. They're 30-year terms. In some cases, we can do 40-year terms. So you're going to feel no different from the government money to the non-QM side when you buy a house. So just want to recap again, because what we're going to do now is go through some case studies. Okay, some clients I've served in the past, and why I think we're the right person or company to work with you is that we are only focused on self-employed buyers and borrowers. This is a full-time job to only focus on this niche. You'll find a lot of lenders that will potentially do one or two of these a year, and the experience isn't quite the best because these are guidelines that are different from the fit in the box type system. We've got the support staff to make sure that this is a very smooth, seamless transaction, and we can cover you nationwide. So we've got tailored underwriting, which means that most of these loans don't fit into a box. Okay, there are guidelines that we do adhere to, but there's also your story. Okay, what is your story? What is your business story? And there's that human element that's taken into consideration when choosing to lend on these loans. Like I said, we have the alternative documentation. You can leave your taxes alone, and the income calculations that proving income consistency is what we're great at, and all those different methods can match your business up the right way. So this all leads to more buying power for you. Okay, we can get you up to a 5 times higher loan amount approval versus a conventional loan. We've helped
Dustin,
first time. Yes.
hey, not to interrupt you, but somebody did ask, do you guys do refinancing as well, or is it only new purchases on?
No, this is the whole gamut. They work for refinances, cash outs, rate and term, and for purchases.
Awesome. Okay, great.
There are non-QM HELOCs, seconds, everything under the sun you can think of. These also work for first-time home buyers. So somebody's been renting for a while who's been kind of locked out of home ownership. We have great programs for those. Let's talk about some of my favorites, though. Gigi and Gerald Bronstrup. He lived in California, been there for 20 years, wanted to get out of the political climate and come to Arizona and kind of pre-retire. They had a house there that they needed to sell, and the credit union banker said, you have to sell before you can buy the new home. His business returns and his personal returns show he makes $9,000 a month, but his business deposits are over $95,000 a month. So we take those, we put them through a business owner's mortgage with a 12-month business bank statement, and we break out the calculation. Okay, $95,000 of average monthly deposits. We do apply an expense ratio. That's for another conversation as well, but just know there always will be an expense ratio dependent upon the business. At standard 50%, that's a $47,500 monthly income to qualify on this loan. 9K goes away. That's the number that we use. They're able to buy the new Arizona home before selling the California home. So they had to move once, make it a very seamless transition. And in about 60 days, everything was done. The purchase on the first was not contingent on selling the old house, and they made the move to Arizona. Vai Vong is an entrepreneur. He's a first-time home buyer. This was an interesting case because he has zero income on his tax returns. And so any bank basically told him, you're never going to be able to own a home. But he had $200,000 in the bank, and his quick serve restaurant did $31,000 a month in revenue. We chopped that in half. He bought a little townhome for $315,000 in 2023, and he's been there ever since. He's then since bought an investment property as well. And my favorite one is Rob Laycock. He lived in California, living in Colorado. He is in the insurance and financial services business. He came down here with a $400,000 pre-qualification from his credit union and 200 grand to put down on a second home, and couldn't find anything that he liked in that price range. He was about to go home empty-handed. His realtor called me. I did his bank statement calculation to qualify him on that. And you can see the number right there. It is way higher than what was claimed on taxes, but the taxes were the limitation for Rob. So I taught him how to do a non-QM loan. He bought this house as a second property in 2023, decided it was too small, traded up for this one in 2024 with a 1099 loan, and is now under contract to sell that one because he's making a new build, which will hopefully be his final home in a matter of 3 years, all with non-QM loans. He's had an aggressive deduction strategy. He has made more money year after year, but with the prices of real estate right now, your tax returns are probably going to be up against a wall with the amount of income used for qualification. And these non-QM loans can be the exact fit that you need to hit your real estate goals. Because home ownership is possible. And that's the thing I love about this business, is that financial structuring can really work if you have access to the right tools. I
Dustin, we
appreciate
got,
it. Good.
yeah. Oh, not to cut you off. Another question. Somebody said, are the interest rate and APR is going to be higher on these than traditional or qualified mortgages?
Absolutely, they will be. Not to the level that you may think. We're looking right now at about a 1% to 1.5% difference, depending upon factors like credit score and down payment. But any of the calculations that I've ever ran, the additional interest is far smaller than what the additional tax liability would be if you have an aggressive deduction strategy.
Yeah, that's very interesting to think about. And when we met, I said, hey, you got to come on here and talk about this because I don't want to say we see it all the time, but we see it pretty regularly where clients are just so caught off guard by this. It's either their first couple of years in business, and so they're really not showing these high profit numbers yet, or things are kind of just still getting established. I think for me, the best part is just to know that there's programs out there and there's options for everybody. So that was really good. I think we're gonna turn it over to Lonnie real quick. We're gonna kind of continue to complete this killer money triangle that we have going on right here. So we can help you pay the least amount of taxes. Even if you're doing that, Dustin's going to still help you get approved for a mortgage to buy your dream home. When it comes to selling your business or getting it ready to sell or getting the max value, that's why we got Lonnie here. And then Dustin, we got time at the end for Q&A too. So I saw a few other people did jump in here in the past few minutes. Just a reminder, use that Q&A box down on there. If you do have any questions, we'll answer them right when they come in. Or of course, we've got plenty of time at the end for Q&A too. So Dustin, thanks so much. I wrote down a couple of questions that I'm going to ask you right at the end of here, but for now, let's
Perfect.
turn it over to Lonnie. We'll keep this thing going. So
Yeah, thank you. That was great, Dustin. I'm good. I need your contact info because I have a business that sells businesses. So I run into that stuff every now and then too, looking at buying something here. But yeah, I'm going to keep it short. You know, Jake already introduced us, but here are the four things I'm going to talk about. When's the right time to prepare to sell the company? What makes the company valuable? What buyers are looking for? And then who do you want on your deal team? Really before you sell or start trying to sell the business, but during the process, even after. But first, why? Why do we want to do this? Why are we even doing a webinar? And you can tell from that stat right there, only 30% of the businesses that hit the market actually sell. And they say actually that's the low stat. There's a lot of companies that don't even try to sell, but the Exit Planning Institute tracks this. They've tracked this at least the last 14 years since I've been doing this. Biz Buy Sell, businessforsell.com. So these are pretty accurate stats where most businesses don't sell. And I don't think they track this as far as business owners that try to sell a business for a certain amount. And I bet you the stat's pretty high. They thought they could sell it for $1 million and they got 700,000 or 2 million. They got 1.5 million. So it's very important to prepare to sell your company. And here,
Lonnie, not to interrupt you, but
yeah,
is it more often than not that people end up getting less money than they originally thought when they're going to sell the business?
yeah, that's what I've said. They don't. I don't think they track that stat, but most of the time they don't get as much. And sometimes a lot of times I'm the bearer of bad news when someone comes to me. I get their financials, do a business valuation, and most of the time they're disappointed. But it does happen where, like the last deal I had, we actually sold it for $875,000 more than what they were looking for, and that's because it was a construction company and they had a lot of work on in the books going forward. So I was able to negotiate that. These are the other reasons why here. Just they try to overprice it. They think they need 1 million, but it's really valued at 700,000. It just doesn't sell, or it ends up sitting on the market for a long time, and then it actually gets worse. It kind of spirals at that point. Um, the best time to sell your business, number two, there is when your numbers are going up. That's when you're on top is actually the best time when you sell. If the numbers are going down, it's tough. Every buyer that I've spoken to over the last 14 years, whether they bought the business or not, they always ask why are they selling? And sometimes I have it on the marketing package. They're 80 years old. That's why they're selling. They still ask why are they selling because they're scared. It's not. It's like that's not like a house. If there's something wrong, they know that they can buy something that could just pretty much crumble within months. When's the best time? They say when you first purchase the business, start the business, you want to start preparing to sell. A lot of experts say 3 years. That's really good. 2 years is fine. Banks look back at 2 years. So when someone's going to buy a business and they want to get an SBA loan, the banks will look back at 3 years, but they will look at it through their calculations on 2 years. So what I tell people, hopefully no one's in the IRS here, but do what you want to for 20 years, hide what you want to, but when you're going to sell about 3 years out, start showing profit. Stop hiding profit. There's every industry is different, but there's kind of rule of thumb or the average business. What we tell people is for every dollar that you're stealing from the IRS, you can get $3 when you sell your business, $3 back when you sell your business. So it's really important to show profit. And here, next stat here or slide here. What makes a company, valuable? It's the cash flow. A lot of people focus on, we're a $2 million company, we're a $3 million company, but really what you want to focus on is the bottom line. That's the report card. How well are you, handling your cost of goods sold? Are you keeping your expenses down? Is everything efficient? So the bottom line is really important. And there's other factors besides the bottom line as far as the cash flow. We on a smaller business we count the owner's salary and those add backs as far as personal expenses. If they're not crazy personal expenses, like traveling, that's fine. Automobile use, that's fine. But these are the things that they're looking for. So Jake, this involves you clean financials. This is the most important thing of everything is clean financials.
Love that.
Broad customer base. So if you have certain clients, if you have say if you have 1,000 clients, you don't want one client to be, the rule of thumb is 10 to 15% more. I had some that had 40, one client was 40% of the business. We still get the deal done, but the problem with it is the value. It's a risk to the buyer. So it lowers the valuation of the business. Same thing I talked about earlier, steady growth. You want the numbers to go up and not down. And if you do have recurring revenue, which I sell a lot of companies that don't. It's not a deal killer at all, but that just makes the company more valuable. So if there's a way you can find some kind of subscription added on to your business where you're getting recurring revenue, that's pretty good too. But sustainable competitive advantage. I mean, that helps out, but it's kind of tough. We're in a copycat world. Like here in Florida, I sell a lot of trades companies, HVAC, plumbing, those types of things. They're everywhere, but a lot are selling right now. A lot of those companies are consolidating, so it's not really a big issue. The biggest one on that list is clean books and records. So this next slide, it's pretty much the same thing. What buyers are looking for, it's pretty much the same thing. What makes the business more valuable? But there's a few things here that weren't on the other page, like potential for growth. When we put the marketing packs together, we find out everything about the business. So we want to know if there's another avenue. If someone's if it's a lawn care business, can they get into sprinklers, systems, things like that, things you can add on to the business. So how can they grow the business? We actually like when we have a business for sale and the website's ugly and they're not doing any marketing, but they're doing 3 million sales somehow. That's actually something good. The non-compete, that sometimes is an issue. Sometimes sellers, don't want to sign non-compete because they may want to start another business in a couple years or in a certain area. So usually when you go to sell your business, you need to be ready to not start that same business within 50 miles, 100 miles from wherever your farthest customer is located. We talked about reasonable price, but available SBA financing, that goes back to you, Jake. They want to look at clean corporate tax returns, P&Ls, balance sheets. All that stuff needs to be clean in order to be qualified for the SBA. So not only the buyer has to qualify with a good credit score and a good down payment, usually anywhere from 10 to 20% down of the purchase price, but the business has to also qualify for the loan. So it's kind of, I wouldn't say like a house. A house can't have a house with structure issues that the bank won't finance it to. Where a business, they look at the business actually more than they look at the buyer.
Lonnie, I have a quick question on there too. Somebody told me the other day, and I know you're not a SBA loan expert per se, but they said essentially if the cash flow of the business is enough to service the SBA loan moving forward, 9 times out of 10, the SBA will finance that deal. Do you have any history with that?
I mean, meaning everything else is good as far as the buyer having good credit and business acumen, because they also want to see the buyer. Do they have experience in this business, or is there a relatable experience? And there's ways to massage that. But yeah, if as long as it covers the debt, and also they want the buyer to also have some extra money left over, like for capital expenditures to make sure
Some
the business
sort of
is running
reserves.
out. So it can't be tight. It can't be just where hey, it's doing 200,000 in cash flow and the bank loans 200,000. That's not enough. It's got to be a little more than that.
Okay, that makes sense.
And that's some of the things here right there, like earnings that provide a buyer a living wage. And most of these buyers also, they want a return deals that are under 5 million typically are financed through the SBA, meaning the buyer can put 10 to 20% down, and the bank will finance the rest. But they're going to run calculations to make sure that they're going to get a rate on the return. Same thing if they just paid all cash, they want to get a rate on the return. So if a buyer can get something better from a stock market or investing in houses, they're not going to buy your business because maybe you're asking too much, or the cash flow is not enough to actually get them a good rate of return. And this is who you want when you're going to sell your business. Right there, it has the business broker or the M&A advisor in the middle. That's kind of, say you call someone like me, I'm ready to sell the business. We're going to do the valuation, and it takes an average of 9 months, 6 to 9 months to sell a business once it's on the market. So at that point, we're in the middle. But someone like you, Jake, beforehand, 2 years in advance, you're in the middle. Or what's now on the slides, a business coach. That's very important. So having a good team is important. Definitely a good business attorneys, very important. You want them to read over all your agreements, your LOI, and someone like you, Jake, during the due diligence. The seller provides us corporate tax returns, P&Ls, balance sheets, things like that. But usually, people in your world, they're going to ask for more information. Bank statements, credit card statements. You guys look at it 6 ways to Sunday.
Yeah, we're gonna really dig in on that, as opposed to the seller wants to kind of paint this picture of, no, everything's great. Like, here's the financials, and we're gonna really dig in, look for verification, and be asking a lot of questions around that kind of stuff.
Definitely. And this is my last slide here, but you definitely want to get with your financial advisor. I always I work really well with them, but sometimes you think you need $2 million for the business, but it's only worth 1.5, and it's a problem if we're trying to do that. I always advise them to go back to their financial advisor, find out if they really do need 2 million. And then obviously after the sale, there are certain ways to shelter your tax when you sell the business. You want to work with your CPA, your financial advisor. There's something called a deferred sales trust that you can put the money in the trust, and you can actually invest in things, real estate and stock market, and where you're not going to get taxed forever if you never take it out. That was it. Thank you.
Oh, that's great, Lonnie. Thank you so much. And we're going to put there too, we'll post in the chat how to get a hold of Lonnie, how to get a hold of Dustin. I'm going to talk about some tax stuff here, which is my personal favorite, but I'm a little biased, but having you guys on here is really good. To me, it's so important to be proactive about this stuff, whatever it is. If you're looking to buy a house, if you're looking to sell the business, the earlier you start, whether it's the amount of taxes you're going to pay for the year, the earlier you start with that stuff, the better all the time. So let me get this going here. And I'm going to dive into a little bit of what we need from you to get going for 2025 tax prep. So, all right, I think I got my screen up there. The time is here, right? 2025 is in the past. 2026 is here. January is over. We're like full speed into tax season, and we're ready to do some tax returns. So from the basics, covered at just kind of like a high level, we got to dial in your income, right? If you're a W-2 employee, you should have those W-2s from your employers. If you're a business owner, you should be getting K-1s. If you're self-employed, you should have 1099s. 1099s also come from investment statements. So if you have interest income or investment income from your stock portfolio and all that kind of stuff, all of those documents should be close to being in your mailbox or your inbox by now. If not, sometime soon, they should be coming. If you're the owner of an S corporation, you want to make sure we got that owner's compensation dialed in from 2025 is very, very important. This is another one too. This is new for this year. If you're a business owner or if you are employed and receive tips or overtime, you want to check it for payroll accuracy. The U.S. government, when they make these big changes, or when the IRS makes these big changes, sometimes everyone out there is not 100% ready for it. So we're already getting a lot of questions on, hey, I got my W-2 and I thought, there was going to be no tax on tips, no tax on overtime, and that stuff isn't 100% reported right. So that is one thing. If you're a business owner and you employ people who get paid on tips or get paid overtime, you want to double check with your payroll company that stuff was categorized correctly. Or if you receive those as forms of income, we want to double check that too. So, and before I keep going too, I see a couple more people popped in. If you got questions, pop them in the Q&A box. we'll make sure we answer all of those before we get done here, or you can hold them to the end, and we'll be able to ask Lonnie and ask Dustin as many questions as we want to. So for expenses, we got to dial that stuff in. If you're a business owner, make sure we have the breakdown between the personal and the business separation. If you are commingling those expenses, we need to make sure by the end of the year we've got everything reconciled and separated and extremely clean going forward before we go for taxes. You want to make sure you really dial in your vehicle, your meals, and travel deductions. If you own a business, we're going to ask you for that business P&L and balance sheet. So that's if you use QuickBooks or some other sort of accounting software, it should have all that stuff nice and organized for you. That's our favorite. If you don't, that's okay too. We just ask some sort of organized spreadsheet, or we have our business expense form that a lot of you are probably pretty familiar with on our website too. We ask you no shoebox accounting. You know, don't bring us that big box of receipts or that big unorganized pile of paper, because that's no fun for anybody. If you got rental properties, and you manage that stuff yourself and you manage all the income and expenses, you can put it together. If you have a property manager, then more than likely they're going to send you a 1099 and then some sort of reconciled statement with all of the categorization of all the expenses on the property at the end of the year. This is a big one because they made some big changes here. So your 1098 form, that shows your mortgage interest and real estate taxes that you paid for the year. One of the big changes from the One Big Beautiful Bill Act last year was they changed it. Prior to there, the amount of real estate taxes you could write off in 1 year was capped at $10,000. They actually changed that and put it up to $40,000. So I say all that to say this 1098 form, it was always important, but it didn't make a difference for a lot of people because of that cap prior. Now, if your real estate taxes are higher, this could make a major difference for you on the itemized deduction section. Then, of course, if you had any major life changes, we need to know about that stuff. So if you got married or you got unmarried in 2025, if you had an extra dependent or you're not responsible for a dependent anymore, we need to know about that stuff as proactively as possible so we can get to work on those tax returns and make sure we're getting you everything that you're entitled to. Entity and compensation, I always love to talk about this. If you're a Schedule C, but you're making over $50,000 net, we probably need to have a conversation around tax planning so we can change that for you. A lot of people don't realize when you are a single member LLC and you're taxed on what's called a Schedule C, you automatically pay an extra 15.3% self-employment tax on all of your earnings. So just for easy numbers, if you are a business owner and you're taxed on a Schedule C making $50,000 net profit for the year, that's an extra $7,500 in self-employment tax that we don't want you to have to pay. So if you are, then we should definitely have a conversation. If you've already made the conversion to be taxed as an S Corp, one of the requirements there is you got to pay yourself a reasonable salary. The IRS doesn't give us a chart of those numbers and say what's reasonable for what business. We just have to sort of come to our conclusion of what that number is. And so we can help you with that. On the other side of reasonable salaries, distributions. Every year we see clients who, for whatever reason, don't have clean and documented distributions and somehow throughout the course of the year get certain things mixed up that should be distributions or shouldn't be distributions. And so that plays a big role in what the net number on your tax return is going to be and how much taxes you're going to pay at the end of the year. So if you have questions about that, let us know. We can help you iron those out. And just know your entity choice, that's an actual strategy. That's not just a formality. I mean, there's all kinds of entities out there. There's the single member LLC, which is the easiest. If you got more than one member, then you're a multi-member LLC, which is taxed as a partnership. It makes sense to convert to being taxed as an S corporation. And in rare scenarios or higher level scenarios, it could even make sense to be taxed as a C Corp. So we want to have those conversations. We want to get that stuff figured out. What happened last year? It was the One Big Beautiful Bill Act got passed in 2025. That was really a revision to the Tax Cuts and Jobs Act, which is what came out in 2018. When that happened, that was considered like sweeping tax reform. That was the biggest change to the tax code since 1987. And the One Big Beautiful Bill Act, it made permanent a lot of the changes from the original Tax Cuts and Jobs Act, which was in 2018, that had these 10-year sunset periods on it. And so this stuff, it affects everybody. I don't want to go through everything line by line and detail by detail on here. What I want you to know at a high level is that this stuff impacts everybody. So if you're a retiree, if you have a family, if you have dependents, if you're just a W-2 employee, this is going to affect you. Or if you're a business owner, is where it has the biggest effect. And to me, there's a lot of stuff in there, but the Number one thing, well, I don't want to say the number one thing, but one of the top things I took away from all my research and getting updated on here is the IRS has expanded funding specifically for auditing, specifically to use artificial intelligence to do it. And so they earmarked $80 billion to go towards AI auditing tools, specifically to focus on high income earners and small business owners. What does that mean? Doesn't mean you should be scared. Doesn't mean everyone's going to get it audited. It just means if you haven't had the tightest accounting system prior, or if you haven't had a good relationship with your tax strategist or tax advisor, now's the time to do that. As long as we're doing everything the right way, as long as we have all of the documentation in place to justify all of the strategies that we're taking, there's nothing to worry about. It just means if you don't have that stuff in place, now would be a good time to look at doing that. And so a little bit of the updates, bonus depreciation is back, which this is what I like to call God's gift to tax professionals. This is one of the ones that was on what was called a sunset period prior. So bonus depreciation is a fancy way to say if you purchase certain types of assets for your business, mainly vehicles or assets, machinery, think like bigger type assets and purchases, you, instead of having to spread the deduction for those assets out over a number of years, you get to fast forward it into 1 year. And so the one that's the most common when it comes to business is Section 179. Specifically has to do with having vehicles in your business. If you purchase a vehicle and it's used in your business for more than 50% of the time and it weighs over 6,000 pounds, you can take a deduction for 100% of the total cost of that vehicle in the first year instead of having to spread it out over 5 or 7 years. That's a huge one. R&D expensing is another big one. So that was research and development expenses prior to the One Big Beautiful Bill Act. Those had to be amortized over time. Those went back to 100%. There's the no tax on tips. So if you work in a restaurant or you own a restaurant, this is a really big one. You need to be aware of how this is going to work because you're going to have to deal with it in your own situation. Or if you have employees, I'm more than positive they're going to have questions on this stuff. No tax on overtime. You can actually get a write-off for your personal car loan interest, which is a very interesting one. To me, there are some qualifications for there that the car does have to finish manufacturing in the US. There's also some income phase outs on these three, the tips, overtime, and car loan interest. So if you make large amounts of money, they might not qualify, but all just depends on your personal situation and exactly where you fall there. Then the SALT deduction, that stands for state and local taxes. That went to $40,000 where previously it was capped at $10,000. Which that's a major win to me. So let's get moving. If you're a client of ours already, that's fantastic. You're probably already started with this process. If you're not, just to kind of update everyone on exactly how that works. We want to get you onboarded as soon as possible. We do that through our support team. And we always start with an engagement letter, which is just a clear identification of exactly what we're doing for you in this tax season and in this tax year. From there, we set you up with a client portal, which is a nice organized place to keep all of your documents. We're not like emailing attachments back and forth and, you sent it to me 6 months ago and now I can't find it and all that sort of stuff. We got one real good, nice organized place where you can keep all those documents every year. And the biggest thing is we want to have a good understanding of all the dynamics of the tax return going into it. So let's have these conversations now. Let's book those appointments. Let's get as much information to the surface as proactively as possible so we can have a good, clean, nice tax season. Lonnie and Dustin, how am I doing? I'm not putting everybody to sleep over there, am I?
Doing good.
Nice. I think somebody's got a question. It says, Jake, as far as claiming dependents, my son is using VA benefits to pay his college tuition. We have been claiming him in the past, but last year was when we found out he qualified through the VA for tuition. Can he do his tax return on his own, or do we need to claim him? VA benefits are his stepdad. That one we should probably do a follow-up. I'm going to copy and paste this. Anna, if you could figure out who that's from, I will follow up with you because that's a little bit more detail. I probably have some follow-up questions, but we could definitely help you figure that out. So whoever it was that asked that, I think you came through as anonymous. If you can just put Vanessa. There you go, Vanessa. Hey, congrats on the new house. I saw you post that the other day too. That was really awesome. So thanks for joining. I will copy and paste that and I'll follow up with you after this and we can break it down. So, all right. So back to the basics, preparation. Also, let us know, are you an extension person or are you an early filer? a lot of people don't realize every year the IRS, they're nice, right? They give you this chance to put in what's called an extension. A lot of people don't realize when you do an extension, it's an extension of time to file your tax return, not an extension of time to pay your taxes. So the original tax due dates for business tax returns is March 15th. The original due date for personal tax returns is in April 15th. You can put an extension, so you can extend those due dates of September 15th and October 15th, but the IRS says you still technically owe the amount of taxes back in March and April. So if you do this extension and you don't make a payment and you owe a larger amount, it can be thousands of dollars in penalties and interest that we want to avoid if at all possible. So let us know, are you an extension filer or are you an early filer? If you're an extension filer, that's fine with us, but we want to make sure 100% you know that we should try to make a payment for as close to what we think you're going to owe as possible, as early as possible. And then communication, just let us know. We have our commitment emails going out. They've already started. In January, you can always reach out to our support team at support@actionaccountingusa.com, or you can call us at the office number, which is 727-799-1040. And so that's what I got for you guys here. If I'd like to kind of open it up to Scott and Lonnie. So if anybody has questions for me or for any of our other presenters, pop them in that Q&A box and we will answer those too. Try to blast through the information as efficiently as possible so we can answer questions and have as many conversations as possible. I go back and forth. I'd love to actually do one of these where everyone could just kind of come live and ask it too, but I've also been told that's a little bit risky and things could go off the rails there too. So, but that's our content. Dustin, thank you so much. Lonnie, thank you so much. Thank you to everybody who joined us. If anybody has any questions, pop those down in the Q&A box. We got another 10, 11 minutes budgeted for the event. We'll hang out till then or until people stop asking questions. So somebody asked, is there an additional deduction for those 65 and over? Yes, there is. The standard deduction has been raised, which is part of the big, beautiful bill as well. So that's like an extra bonus deduction that was in there as part of that. So and I always say, if nobody does have any questions, that's because we covered everything so thoroughly and so efficiently that nobody could have any extra questions, actually. Then while we're waiting for those to come in, Dustin, or no, sorry, Lonnie, I did have a question for you because you mentioned the non-compete there within a certain amount of miles of the when somebody sells their business, having to sign a non-compete within 50 miles, I think you said, of whatever. How is that affected by kind of the whole virtual thing now? Does that make a big difference there, or?
Yeah, if they're clients all over the place, then yeah, that could cover that. I remember years ago we had one that wasn't virtual. It was just a local business, but they wanted 2,000 miles or 1,500 miles, and it got it wasn't going to be held up, so that the attorney changed it down. But if your clients are all over, like the business I sold last year, they were in 27 different states, then yeah, you can't be in that business anymore.
Basically, that would expand the range of your non-compete to all over the place of where you used to sell, huh?
Yep, wherever the customers are, wherever, pretty much, not the business itself. You have a business here, but you've got customers in Vegas, New Jersey, that it needs to cover those areas.
Very
I'm
interesting.
not an attorney, though, but that's from my understanding.
No, I love it. And Lonnie, remind us, what's the best way people can get a hold of you? And then Dustin, I'll ask you the same thing right after that.
Yeah, my number is 727-238-4074, and Lonnie is the email address, lonnie@southfloridama.com. M as in Mary, A as in Apple.
Okay, perfect. We'll include that when we send these out to everybody. Dustin, what's the best way for people to get a hold of you if they have any questions or want to follow up with you?
Emails Dustin@businessownersmortgage.com. Call, text 602-750-9460. Happy to answer any kind of questions you got, no matter what your time frame is. Generally, my business owners come to me about 60 days before they intend on shopping for a home if they are purchasing. And refinances happen at any time. All we need to do is just get the documentation and the structure proper and correct.
Nice. Then for us, you can always go to our website, which is actionaccountingusa.com. There's a button there to book an appointment with us right on that front page. We're going to call the main office number. You can have our support email too. So, guys, I don't see any other questions coming in here. I think we'll stick around for another minute or two, see if anybody has anything to pop in there. If not, we'll give everyone a couple minutes back in their day too. So, and I'm sorry, I didn't get the name on who asked that, but the additional deduction, it's additional standard deduction for 65 and over. It's additional 6,000 for seniors. So that was a nice little thing they squeezed in there with the One Big Beautiful Bill Act. So. Yep. I don't see any other questions coming in here. If nobody's got anything else, we'll wrap this thing up here. So this Ginger, is that Aunt Ginger? Look at that. She said, great information as a CPA. I deal with business owners that could benefit from Dustin's company. We'll pass this on. So that's great.
Thank you, Ginger. Really appreciate that.
Hey, that's Aunt Ginger. Okay, Dustin, come on. That's actually my aunt.
Okay.
That's too funny.
Oh, very nice. Very nice, Aunt Ginger.
There we go.
And also for everybody here, still my website, businessownersmortgage.com. If you visit that, want to play with some numbers, I've got some really slick calculators on the tab up top. It's not just a basic mortgage calculator. You can calculate affordability. You can look into rental properties, calculate net cash flows, all that kind of stuff. Completely free to use. If you want to keep in touch with me, you can hit that get quote button or just fill out the lead card. All that does is just get me your information so we can stay in touch. Certainly not a spam type of business, but it is a really, really cool calculator tool on my website.
What's that again, Dustin?
Businessownersmortgage.com.
Okay.
One of the things, Dustin, I thought was really interesting is like, this is what you do, right? Like you're not like a traditional lender who can also do this. This is your specialty. This is what you guys look for. To me, that's what was the most appealing when I met you and why I wanted to come on here. I've heard of some of these type programs from more traditional mortgage lenders, but they always kind of try to back off of it a little bit because they don't really want to touch it. Like this is what you do. You get hands-on, you dig in, and you're looking to do this program for everybody. So
yeah, it is. It's the traditional mortgage system has an AUS, an automated underwriting system that makes the job easy for all those conforming loans and those qualified loans. This is definitely more of an art form that requires relationship driven kind of stuff, and that's absolutely what I love.
Love that. All right, cool. Well, guys, thank you so much. Everyone who joined us, thank you so much. If you're here live, we appreciate it. If you're watching afterwards on the recording, we appreciate that as well. You know how to get a hold of me, Dustin, or Lonnie if you need to. If you need anything, reach out. If not, we'll talk to you soon. Thanks, guys. Have a good one.
See ya.
Yes.
All right. See ya.